Hello and welcome to AI Market News by LM. Well, global markets are a sea of red this morning, and it really all comes down to a massive, and I mean massive, surge in oil prices. But amidst all of that chaos, there's one currency that is on the absolute edge, the Japanese yen. It's plummeting towards a number that has pretty much everyone holding their breath, which brings us to the big question on everyone's mind. Okay, let's dive right into this. So what's the big deal with 160? Why is that such a critical number? It's really more than just a figure on a screen. It's a major psychological line in the sand. For weeks, traders have been whispering about it, and now it looks like a perfect storm of global tension and inflation fears is making it seem like a very real possibility. Just look at this sharp upward climb here. The dollar has just smashed right through the 159 yen mark, hitting its weakest point so far this year. We're now closing in on that 159.45 level, and if that breaks, wow, we could see a very, very rapid surge. This, of course, puts the Bank of Japan in an incredibly tough spot. So how did we get here? We're going to connect all the dots for us. First up, we'll look at the oil shockwave that really kicked this all off. Then we'll trace those ripple effects across global markets. We'll zero in on why the yen is so close to the brink and try to understand how this is making the Fed's plans so much more complicated. And finally, we'll see what we should be watching for next. Everything that's happening in the markets right now really traces back to one single catalyst: a sudden and pretty dramatic spike in the price of crude oil.
Brent crude has surged past $100 a barrel. This is a massive move, and it's being driven by a dramatic escalation of conflict in the Middle East that is just stoking fears of a major, prolonged disruption to global energy supplies.
And this isn't just some vague tension. We're talking about specific, market-moving events. Reports of attacks on oil tankers in Iraqi waters, and the evacuation of a key export terminal in Oman. This has traders seriously worried that the flow of oil through the critical Strait of Hormuz could be threatened, which would, of course, send inflation soaring. So let's move on and see how this all builds. Now, an oil shock like this, it doesn't just happen in a vacuum, right? It's sending these powerful ripple effects across every single asset class, from stocks all the way to bonds. The immediate impact is crystal clear if we look at the US stock futures. The Dow, the S&P 500, the NASDaq, they are all pointing to a lower open. This is a classic risk-off move, where investors start dumping stocks because of all the uncertainty and, of course, the fear of higher inflation. And it's not just stocks. The bond market is also signaling some major concern. The yield on the 30-year US Treasury bond is surging. And this is a really clear sign that the market believes the fear of inflation is very, very real, and that's forcing borrowing costs higher. All of this, the conflict, the rising prices, it's taking a huge toll on market psychology. We're seeing sentiment, according to indicators like the Fear and Greed Index, shift rapidly away from greed and move squarely into fear territory as everyone just braces for more volatility. Okay, now let's bring it back to the star of our show today, the Japanese yen. All of these global pressures, a stronger dollar, higher US yields, soaring energy prices, they are all converging to push this currency to what really looks like a breaking point. This sharp move past 159, well, it puts the yen firmly in the danger zone. And here's why this is so critical for Japan. As a major energy importer, higher oil prices are already painful. But a weaker yen makes those imports even more expensive, and that creates a vicious cycle. At these levels, we can almost certainly expect to hear from Japanese officials trying to jawbone the currency back up. So what's really interesting here is how this highlights the diverging problems facing the world's two most important central banks. On one side, we've got the Bank of Japan, which is just trying to stop its currency from collapsing. And on the other, we have the US Federal Reserve suddenly dealing with inflation coming back, just when it probably thought it had it under control. This brings us right to the Federal Reserve. Just a few weeks ago, the market was pretty confident about seeing multiple interest rate cuts this year. Well, this oil shock has completely upended that outlook. So the crucial point is this quote. It just perfectly captures the massive shift in expectations. The prospect of persistent energy-driven inflation means the Fed has very little room to cut interest rates. Hopes for a whole series of cuts this year, well, they're quickly evaporating. And this illustrates it brilliantly. We can see right here what the market is now pricing in. Futures data shows the probability has overwhelmingly shifted towards just a single rate cut this year, with a growing chance of no cuts at all. It really seems like the era of cheap money isn't coming back anytime soon.
So, with the situation changing by the hour, what are the key data points that we really need to be watching in the days ahead?
Looking at the economic calendar from investing.com, a key number to watch this week is Thursday's U.S. initial jobless claims. Markets are going to be watching this one very closely for any sign that the U.S. labor market is weakening. That will tell us how the economy is holding up under all these new inflationary pressures. Which leaves us with a final and pretty crucial question. For months, we've all been hanging on every single word from central bankers. But with oil prices being driven by conflict, are the policymakers over at the Fed and the Bank of Japan still in the driver's seat? Or have they kind of become passengers, simply reacting to geopolitical events that are far beyond their control? This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.